From downtown Milwaukee, welcome to Money Talk with Bob Landis. Each week, professional advisors from Landis & Company Investments discuss the latest financial developments, offering timely insight and long-term perspective.
This is Money Talk for Labor Day weekend 2025. Let's see what's happening. Well, the Brew Crew is out of town this weekend, but they're back at AmFam for Labor Day with the Phillies. Then they hit the road for a week. There's a Third Ward Artist Fest happening this weekend, Labor Fest at Labor Day at the Summerfest grounds, and you want to keep an eye out for Harleys. The 3-day weekend, most of it happens at the Harley Museum, and then there's a poker run on Monday, so keep your head on a swivel. The NFL kicks off in a week, so let's start with a football story. 73-year-old Bill Belichick, who has won 6 Super Bowls as coach of the New England Patriots, is dating 24-year-old Jordan Hudson. Let that roll around in your brain for a minute. Well, Jordan just applied for a trademark for the term gold digger. And I can't make this stuff up. A probationary firefighter in Missouri had an unusual introduction into the world of fighting fires. The Doolittle, Missouri Fire District revealed that it's only one vegan recruit. There is only one vegan recruit. Jenny Ulrich was among those called out Monday morning to a tractor-trailer fire. The truck was hauling 40,000 pounds of ribeye steaks, and they're all well done. And from London, we get this one. Convicted criminals, instead of going to jail, are being banned from pubs, music concerts, and even soccer matches because of the overcrowded jails. The British government says house arrest will force them back to the straight and narrow. Under house arrest, they can still buy alcohol, listen to and watch live concerts, and watch soccer 24 hours a day on TV. The only thing missing is a free DoorDash. On the podcast today, we have Mike Hoelzl, John Sandstrom, Joel Driesing, and wrapping up the week, here's Kyle Tetting.
Well, thanks, Max. A fairly quiet week overall. Volume's exceptionally low, not atypical of this time of year, as I think we regularly like to point out that most of the traders are at the beach. The NASDAQ this week, though, down 0.2%, down 41 points. The S&P down 0.1%, down 7 points on the week. And the Dow Jones Industrial Average closed on Friday at 45,545. That's down 0.2% after dropping 92 points on Friday. For the year, NASDAQ up 11.6, the S&P up 10.6, and the Dow Jones Industrial Average up 8. Mike, not a ton to talk about this week. We could certainly go down the Packers and Cowboys trade path, which I'm sure might be more interesting than a lot of the market and economic news.
I have 4 hours of material. Buckle up.
But I do think, a couple of interesting developments and a couple of interesting headlines in kind of the financial news recently. One of the ones that you pointed out to me early this week was this kind of the conversation we've had regularly about how many fewer publicly traded businesses there are out there, really going back to a peak back in the kind of mid-90s, maybe half as many publicly traded companies. And we've talked at length about how private equity and just kind of consolidation in some of the biggest businesses has driven a lot of that change. But the new one was kind of the prevalence of all of these new vehicles for investing in those fund companies, to the point now where we have more options to buy baskets of stocks than we do individual stocks to buy.
As of right now, as you just said, there are more ETFs available on the market for purchase than there are individual stocks. That is an insane thing that I just said if you're an investor, right? Because as someone said, and I'm not taking credit for this, there are now more recipes than ingredients out there, right? And that just and also for investors, what this means is, where do you look? Like, what kind of diversification are you getting? Because as you said, you got right now, especially in the small cap industry, you've said this before. If a small cap company has a good idea, it's getting bought up by the bigger players. So that just means that pool is shrinking even more. So when I look at this and say we have more ETFs than stocks, I have a feeling that's just going to keep growing because more and more people are putting out ETFs. Because ETFs have been, and how many times can I say ETFs in a 30-second span, is more and more people are putting these products out there because they're kind of revolutionary in a way for the investor, right? You get the basket of Like it's like a mutual fund that trades like a stock, trades like that. And now you see more and more people putting them out there. I don't think that's going to stop, and I don't necessarily think that's great for the investor, because what happens is now I'm going to buy this new ETF because I heard about it on Bloomberg or wherever, but it looks awfully a lot like the last ETF that came out because it has a lot of the same names in it, just a different shiny wrapper, or a different guy on CNBC said, hey, look at my cool ETF that my firm is doing. So I think it's going to be a little problematic for investors going forward.
Well, I think the big challenge is, and you hit the nail on the head there, that it isn't so much about the wrapper. It's more about what's the candy underneath. And if you're ultimately offering 10, 20, 30 different wrappers, but the underlying thing that you as the consumer of that product are looking for is all the same, why does it matter? How do you differentiate? And I think it becomes a mess for investors to try to navigate an investment landscape in which, okay, which of these recipes is going to be the best use of these limited ingredients, when the reality, I think, is that we need to do a better job of figuring out what ingredients is it that we actually want, and how do we make sure that the wrappers we're choosing are doing that. And so I think more isn't always better. Certainly I like options, but at the end of the day, it's less about how are we packaging these things, and it's more about what's actually inside those wrappers.
And your options even are getting a little bit more condensed even in index funds, right? We talked about this, where right now, if you own an S&P 500 fund, like, yes, you have access to 500 different stocks, and that's a good thing. But the weight of that is getting tighter and tighter. I mean, right now, NVIDIA is more of a weight than, I just want to double check my numbers, energy, utilities, and real estate combined in the S&P 500. The Mag 7 is approaching 40% of the S&P 500. So even in a broad-based index fund, things are condensing, and they're all, I mean, the S&P 500 index fund is starting to look more and more like a large-cap growth fund, because that is starting to dominate the entire fund. So again, it's just a lot of repeating is going on out there with a lot of different funds,
with 20 different investment companies building the same S&P 500 index. And so if you're not going to build a better mousetrap here, maybe pursue the things you're best at. And again, I think the challenge for investors is, how do we figure out which of these are things that actually make sense? That's what we're here for, obviously, is to kind of help wade through the mess that's out there and go, here are some things that we think are actually worthwhile because they're low cost, because they're maybe they do have some process that's a little bit more appropriate for what you're trying to accomplish.
Yeah, I mean, cost is a big part of it, but also you look at, we have a couple of the value funds that we use look at value differently. And I think, there's no pun intended, that's very valuable, right? It's, if you can get funds that technically are in the same space but have different ideas of what that space looks like, I think that's a great thing to have. But again, the more ETFs you get, the more they're just going to get the same overlap, and I think that's a problem for people.
Yeah, I think that's fair. John, we were talking a little bit before the show about just how strong the markets have looked this year. S&P up, including dividends, north of 10.5%. Now, 8 full months through the year, and I think you were sharing with me a question you got from clients on, all right, things don't quite look, at least from a kind of high level, 30,000 foot, like the market should be up that much. So how do we get here?
Yeah, and we'll get to, I'm sure Joel will be telling us a lot about some of those factors later. But a lot of that stuff is, starting to creep towards being on the more negative side. So my client did ask, given everything that I've heard this year, given everything that I've read this year, why am I up as much as I'm up? And I like to point to two factors that have kind of been ingrained to me since I started working here, would be, interest rates and earnings. If you look at this year so far, we're double digits on earnings so far this year from the S&P 500, which is, the 25, 30-year average on earnings is 7.3%, so well ahead of that. Earnings forecasts for the next couple years are around 13%. And then if you look at interest rates, we're the 10 years 30 basis points down from where we started at the beginning of the year. That's indicator makes things a lot cheaper for people, cheaper for businesses to lend, all that kind of stuff. Loans The Fed has now said that they're kind of inching towards maybe potentially cutting rates again in September and potentially one more time before the end of the year, which also helps that use case. Not to say that those projections are going to be exact by any means, but the fact that they're even projecting that high is definitely something to be positive about.
Yeah, I think that's fair. And certainly, the challenge is if it's 13% forecast growth, maybe it comes in at 8 or 9 or 10, that's going to be a big step back, but that's still a better than average earnings rate.
So Kyle, I have a question that you may be able to answer here.
Oh, great. You put me on the spot.
I do my best. I find you see the earnings estimates going up, and I find it very interesting because you are seeing job growth or, kind of weaker job numbers, the quits rates now where they're at, where we'd like to see them. And I was just wondering, are earnings estimates more like, are they higher because Wall Street really has no idea how to model at this point in time because things are changing so quickly? I mean, on a dime, one day we have tariffs, the next day we don't. One day we have a fully private intel, the next day we don't. Or is it just more of a reflection of pretty much like how dominant tech and AI spending is? Because CapEx spending for AI is off the chart. So as long as that keeps going up, is that just going to keep driving earning estimates, or are they just, all right, we'll go up because things seem good until they're not?
Yeah, I think when we talk about earnings estimates, it's like saying we're going to get ice cream. What I mean by that is that there's a lot of different ways you can measure, right? There's a lot of different flavors when you run to Baskin Robbins. And so when we're saying, earnings are going to be up 13% or 10%, a lot of times what we're looking at is this analysis of individual businesses, taking them from here's what these 500 businesses look like, and then building it up to some big number. And so we call that kind of bottom-up analysis, right? What do these individual businesses look like? But then you also have this top-down where you say, what do we think earnings are going to look like relative to where we think the economy is headed? When we're talking largely about earnings forecasts, we tend to be looking at those bottom-up analysis. And the challenge in doing that is that we can only operate with what we know to be true because those analysts are stuck in the environment they're currently in. And so you can't really factor in what's my prediction on this economic change, this tariff change, whatever, because we don't know it to be true. And so the analyst's hands are more or less tied. And so I think those earnings forecasts can certainly evolve based on some of that conversation. The thing I know to be true, though, more than just about anything else with respect to businesses is that they are incredibly good at making money. John, it's something you and I were talking about. The whole reason a business exists is to be profitable, and that's why we invest.
Yeah, and we actually talked about this a while ago in regards to tariffs is a perfect example of this. Obviously, it's completely uncertain, but you could pretty much guarantee that every large business out there has 10 different plans on how to navigate that stuff when it becomes more certain, right? The goal of the business is to be profitable, to make money, to figure out ways to be more productive, more efficient, and the United States businesses are very good at that.
And they're very good at that, often despite economic climate. That, things can look better or worse, but good businesses find ways to navigate those issues because eventually, at least historically, the economies come back around to some more typical rate of growth. And when they get there, you want to already have owned the businesses that were positioned for it.
See, I knew you'd have an answer.
Well, you make it easy. Joel, certainly the economic piece of that is a big piece, and some bigger data this week on some of the most important pieces for us. I think consumers in particular, a big number at the end of the week here on personal spending and just kind of what that picture looks like, and some confidence data earlier in the week.
I was going through all of the indicators that I was following this week and found consumer-related aspects to all of them except for durable goods, which and I didn't dig hard enough there, but you could find that there. And all of it is pointing to weaker consumers. We had the consumer sentiment number today from the University of Michigan that shows that in a broad array of consumer interviews that people are feeling more constrained because they're expecting higher prices. They're expecting inflation to go up. Similarly, with earlier in the week, the Conference Board's consumer confidence number that keeps getting weaker too. But we also had numbers on housing this week from new home sales and from what's got a new name now. It's the S&P Totality Case-Shiller Home Price Index.
We've added another name to what was once just the Case-Shiller.
We received,
leave it to academia just such a concise
we
way
received
to do it.
no compensation from Totality from saying their name. But in both of those, there's talk. Also the pending home sales from the National Association of Realtors. We're hearing more about buyers remaining hesitant. The analyst for the Case-Shiller Home Price Index said that usually you expect seasonal patterns, and it's not happening because housing demand is lower. One of the things that's happening because of that, which is a good thing for the inflation side of things, is that with lower demand, the housing prices are not rising as fast as they were before. So for the last 2 months, for May and June, for the Totality Index, housing prices actually were rising slower than inflation, than general inflation, which is good because that means that eventually, or it suggests that eventually, inflation overall might be getting weaker. The big report that we had this week was an update on the gross domestic product, which measures economic output. See what you think of this analogy. I was thinking of this, of a tub, and you've got spouts going into the tub, output of goods, output of services. Okay, so the tub is getting deeper and deeper, and you're trying to measure how fast those inflows are coming, right? That's what we're trying to do with GDP. What happens, though, is sometimes you reach into the tub and you mess things up. So it's harder to measure. So you've got tariffs, you've got changes in immigration policies, you've got changes in federal government spending and employment levels. And when you do that, it's harder to measure how fast that stuff's coming in. So I say that because I think it's going to be a couple of quarters at least before we get a real read from the GDP reports on how much our economy is growing.
It's a jacuzzi tub.
Yes.
It's a jetted tub.
Thank you. Yes.
No, I think it's a good analogy.
We get no compensation from jacuzzi.
And it was brought to you by the S&P Totality Case-Shiller Home Price Index.
And I think, again, the kind of the tough part of the conversation on GDP is just how important it is overall to the way we view how things are going. And the reality is it's often years before we have the complete picture. I mean, we're talking about multiple revisions, but even then, after the final revision, there's still a lot of stuff we learn about. Here's what was going on 6 months or a year ago.
The rub is this is what we have, right? And you've pointed this out before with a number of indicators, is that maybe we're not measuring what we need to be measuring in this day and age to be measuring what we're trying to measure.
I think that's fair, but it's the tool we have, and as long as we're consistent in saying, well, here are the flaws, understand the flaws, but if you understand the flaws, it's at least fair to say, yeah, this is how we measure, and so this is one of the ways we're going to look at it.
But even with that, the point I was making was even with that GDP report, we're seeing that consumers are spending, they spent more in this revised report for the second quarter than they did in the earlier estimate, but it's still the second slowest consumer spending output that we've had in 2 years. And remember that consumer spending is 70% of our economy.
And so encouraged that the second quarter looked a little better than we thought, encouraged that it's a big number after what was a pretty weak first quarter. But again, now we're already looking at what does the third quarter look like? And the spending is going to be a big piece of that report. And if it is softer, it probably also means that when we do finally start to report in retrospect what the third quarter looked like, it may not be quite as great as what we're coming through. So, I think it speaks to if everything seems to be softening a little, why are we up as much as we're up? And again, I think it speaks to investors' confidence in the investment experience that as long as businesses are continuing to focus on the higher good, as long as they are continuing to put capital to its greatest use, that investors get rewarded by that profitability, by those gains. With that, we enjoyed doing the program for you. We'll talk to you again next week.
Thank you for listening to Money Talk with Bob Landis. If you have a financial question you want answered on next week's show, email it to moneytalk@landis.com. To keep informed throughout the week, visit our Money Talk page at landis.com.